Welcome to Teachers Talk Money, where a millennial high school teacher and a Gen X elementary teacher get together to talk all things money.
From salary scales to saving, investing, and self-care, we're here to help teachers master their money. I'm Christy.
And I'm Rachel, and we're so glad you're here.
Hey listeners, welcome to our next episode in our Summer Money series. We are so glad you're here. Thanks again for tuning in this week, and we cannot wait to jump into this episode with everybody. Rachel, how's it going?
It's good, Christy. Thanks for asking. My update this week is just that it's summertime, which means I'm living off of my savings for the months of July and August. And that is kind of difficult for me. I like not working a lot, obviously. That's a huge pro. But I sort of feel simultaneously happy about being able to take the time off and focus on other important things in my life and other passions aside from teaching and working. But I always feel a little bit of pressure when I see my net worth stagnate or decrease for the 2-month period because I'm essentially draining a certain savings account I had in order to support myself. So I always have mixed feelings about this time of year, but I think it's just important to remind myself that I'm still building wealth and my big picture plan is still working, even if it doesn't look that way in the short term. So that's what's kind of been on my mind. But how are you?
I am doing great. It's so funny because I am technically a 12-month employee, but we get one gigantic check in June on our last day of school. And then that has to last all summer. So whoa. It's still kind of the same thing where like we still have this lump sum that we have to spread out throughout the summer. So it's always interesting to hear teachers being like, I can't wait till payday in September. And it's like, yeah, we really do have to be conscious about that kind of no matter what boat we're in, unless maybe there are some districts that actually send you a check every month. But yeah, we're in charge of it. We have to be responsible for it from June. So I just had the coolest week. I had one of my dearest friends give me a gratitude journal for my birthday a few years ago. And I love this friend so much. And I was like, what a special gift. And at the same time, I was like, I do not have time to journal. I don't need to journal. Who has time for that? But it's really sweet and maybe I'll use it. And then this week, I was listening to an interview with Michelle Gielan, who wrote Broadcasting Happiness. And she talked about how gratitude and optimism, if we practice them daily, actually make our brains work better. And they actually help us solve problems faster. And they help us just kind of be more effective throughout our entire day. And I was like, dang, okay, there's a whole lot of science and a whole lot of potential in this gratitude journal that I've had sitting on my shelf. And so I opened it up this week and started using it. And it was so powerful. I'm loving it. I'm loving looking back through and seeing the little things that I was grateful for and just kind of looking forward to the day in a different way. And it's just been really very, very powerful. So thanks to my sweet friend that gave it to me and practicing gratitude. Who knew?
Was that the Afford Anything podcast you were listening to?
It was, Miss Paula Pant.
I listened to the same one. And I heard the same information and have not put it into practice.
Oh,
like you have
totally should.
Yet, growth mindset. But that's awesome. And that is so funny because I read your note and I just didn't remember like the person's name that was being interviewed. But I was like, that's so funny. I heard the same tip about thinking about 3 things you're grateful for and why and how much of a game changer that can be for like everything in your life. Wow, that's hilarious. So we both listened to that.
Well, and it's interesting because you can hear people say all the time, like, oh, meditate, oh, keep a gratitude journal, oh, do this and that. And like sometimes just the slightest pivot on that information and having it presented in a different way or from a different person can make it hit home in a completely different meaning. And that's what it did for me. I was like, wow, this is super powerful and I should be doing this. And I'm really glad I am.
Yeah, I love that she got into sort of the science and research behind it. And for our listeners, this is a podcast called Afford Anything. And if you're really into this money stuff and you're looking for other great money podcasts, I highly recommend this one. I would say it's more like FIRE focused, so more of that like financial independence, retire early focused. And it's a little bit more advanced at times. Like she'll talk about investments, I think, in a pretty sophisticated way. But pretty interesting. If you're ready for like 2.0 information, I would definitely recommend Afford Anything. Before we get into the episode, we also want to remind you guys to please, please, please make sure you're subscribed to our podcast wherever you listen to podcasts, and leave us a review if you listen on Apple Podcasts, because this is huge for us in getting more teachers to be able to find our podcast. And of course, if you have a question for us to answer in a future episode, or if you would like to share a money win, or you have another unrelated question that you'd just like to ask us, please email us at teacherstalkmoney@gmail.com. We have an email address now. So send us questions, feedback, money wins. We would love to hear from you. teacherstalkmoney@gmail.com.
Definitely. That would be so wonderful to start connecting with our audience even more. So in this episode, I literally put on a real shirt today and brushed my hair. I'm so excited for this episode because we are going to start talking about investing, and investing is my jam. I feel like it is something that I am super passionate about, and I've literally been counting the days until we can dive into this topic. So with that in mind, we're sharing this information so that you can educate yourself on which options are best for you and even what your options are. We are super excited to get into this topic. And Rachel and I both see a streamlined, simple version of investing as a very powerful tool. It's important to know how your own circumstances fit with any ideas or models that you learn about, either from us or from a book or from other podcasts or from your uncle. You definitely need to look at all of these resources and say, okay, now how does this apply specifically to my life? So we hope you listen and learn and keep learning. And also, if you are wanting to know more, my blog is packed with this information in more detail, and financiallyfitteacher.com could definitely tease out the specifics in writing a little bit more. But we're so excited to jump into this today.
Yeah. So we're going to get started with talking about the why this is important, why you need to learn about investing and start getting your money invested. And the first reason why it's super important is that you cannot just save your way to financial independence or retirement or wealth building for other reasons. So an example of this is, even if you had the best savings account, it still isn't going to keep up with the rate of inflation. So for example, pre-pandemic, a competitive interest rate on a high yield savings account was 2%. So theoretically, if you had your money in the savings account, it would grow about 2% per year. But inflation averages at 3%. So even if you're saving all this money, you're still not really outpacing inflation. However, if you're to invest your money, the stock market averages a return of about 7 to 10% per year. So investing is crucial to actually growing your money, which is something we should all be focusing on.
Definitely. Your money is guaranteed to be worth less in the future unless you make it work for you and unless you let it grow in something like the stock market. So the real question is, why are so many teachers standing on the sidelines when we could be building wealth through investing? And even that word wealth might have a noticeable stigma when you hear it. And especially in teaching, because we're not supposed to be wealthy, right? We're supposed to be these poor martyrs who aren't in it for the money. And that's part of what we are here to completely ditch. And teachers deserve to be building wealth just like anyone else in society deserves to be building wealth. It's not a selfish or greedy thing. It's something that you need to be able to do to support yourself in retirement and not have to have an unnecessary burden or risk put on your family or yourself. And the truth is that our pensions and Social Security and Medicare likely won't provide all that we'd like to have in retirement. So that idea of building wealth through the stock market is something that teachers traditionally, I don't think, identify with, at least in the paradigm that we have now. Maybe some of us individually do, but we're not talking about it as a group. And we need to start talking about it as a group because it is one of the most powerful and exciting ways to set your future exactly as you want it to be.
Yeah, I love that you mentioned that about retirement, because a lot of people will think, oh, well, I don't really need that much for retirement, or I have Social Security or my pension. And A, you're totally right that those aren't going to cover it. But B, if you don't have enough for retirement, then you are placing that burden likely on a family member that's close to you, which I don't think any of us want to ever have to do. So that's a big thing. And then on the flip side, I also love to emphasize investing for people who have children or plan to have children, because you want to be able to leave some money to your children. If you want your children and their children to be secure and have hopefully more opportunities than even you did, then investing your money is absolutely crucial in order to build generational wealth. So it's not just about building wealth for yourself and your retirement, but hopefully being able to give something to your family, whether that's just covering college or being able to pay for their first cars or passing down money after you pass on or when they're of a certain age. All of these things are absolutely crucial to building generational wealth, which is a huge factor in the success of people in the future. So keep that in mind, that this is a great way to build a life that is awesome for your kids and their kids.
Yeah. And in addition to that, building wealth also creates opportunities and options in the near term as well as in the distant future. So say you want to make a career change someday or move to a part-time schedule, take a sabbatical, retire early, start your own business or anything along those lines, knowing that you have investments that you could be living off of and not even drawing down on your principal, just living off the earnings those investments make every year is incredibly powerful. And it just lets you breathe a little easier and opens up so many options. So investing in the stock market is an incredibly powerful wealth building tool. It can be easy and fun. And the coolest thing is it's passive. It's a passive way to put your money to work for you while you run the rest of your life. I run all of David and I's investments and I spend max 10 hours a year on it. And they're just cranking away.
Yeah, I love that you mentioned that it's passive in the time sense too, right? Because you sort of do the initial work of setting up the accounts and having money from your budget that's allocated to go to those accounts. And then you sort of just let it do its thing. And then the money comes passively too. So for example, last month, I think I made $600 in my investment accounts. And obviously that's just sort of a random data point I'm plucking. But that means that I have $600 more invested than I would have had before. And I wasn't even investing, I think I was investing about $600 a month last year. So that's like an extra month of my contributions that are happening without me actually having to sacrifice that money in my budget as it stands.
Definitely.
So now we want to address a couple of investing myths because there is so much bad information out there, or maybe not bad information, but information that isn't great for everybody and maybe isn't representative of what you want to do. The first myth I wanted to talk about is that investing means trading individual stocks. So a lot of people will talk about buying Apple or Disney, or GameStop is an example that came up a few months ago. An individual stock in a company just means you're buying a share of the company. What most successful investors do is instead use vehicles like IRAs, 403bs, and 457 to invest in funds. So a stock is one share of a company. A fund is a collection of stocks in different companies. So these are less risky because if one company tanks, if Elon Musk sneezes and Tesla goes down, it's okay. You're going to be able to make it up with the other companies. It will average out to a certain amount. So it's much less risky, and you don't need as much knowledge about all the companies you're invested in, and you don't need to speculate about what you think this company is going to grow to. Instead, you just choose a fund and stick with that fund. You can have very specific index funds or very broad index funds like the total stock market fund. Index funds are great because you can keep your fees super low by choosing a low cost index fund and have your risk dialed to whatever level you are comfortable with. So we are all about the index funds, and you can invest in these using the vehicles that we already have, IRAs, 403bs, 457s, which we'll get far, far deeper into in the next episode.
Yeah. And when Rachel opened with, many successful investors use their accounts to invest in index funds, that includes like Warren Buffett.
Oh, yeah.
Now he does definitely trade individual stocks, but in his estate, the plan is for his family to be invested in an S&P 500 index fund, which means no more individual stock trading. He is leaving his family's future and his bajillion dollars to an index fund that's invested in the top most valuable 500 companies in the US. And so just to add to that, an index fund tracks a particular sector or index in the market. So you can have an index fund made up of small companies or large companies or international companies or technology companies. And that's where the things get really, really simple because you're not picking 15 different stocks and having to track all those companies. You say, I want to be invested in the total stock market. It's diversified. It's going to cover all my bases, and you can go from there. So index funds are something you'll probably hear a lot about, and they're awesome because they're low cost, they're diversified, meaning you don't have a lot of risk, and you can get more specific if you want with them. So myth number 2, the next thing we might hear that's going to make us go, oh, I'm not so sure about investing, is that investing is very risky. So first of all, like Rachel talked about earlier, it's more risky not to invest because of inflation outpacing the earning on your savings account. And then we also think, like I grew up in the age of Enron, which was this gigantic company that lost everything. And people that were only invested in Enron lost everything that they had saved. And then there was like the Bernie Madoff and, all of these Ponzi schemes and these shady characters. And that's the picture people have of investing in their mind. Mm-hmm. And that is just one teeny tiny slice of what the stock market can do for you. The truth is that the stock market as a whole over time averages 7 to 10% growth. We have recovered from every crash. I mean, we started investing just before 2008. And I was frankly glad because I was so busy at the time. I didn't have time to even think about should I get out of the market? But we just kept investing and kept investing all through that downturn. And guess what? The market is up higher than anyone could ever have imagined. Now, could your investments drop in value and stay down for longer than 5 years? That has happened before, very rarely. And there are things you should do to minimize your risk if you'll be tapping into your retirement accounts within 5 to 10 years. But if you're invested in a total stock market index fund, as I am heavily invested in, and that means I'm invested in every single company that's publicly traded in the US, if that fund takes a downturn and continues to plummet for a long period of time, then we've got problems that are likely affecting every aspect of our lives, no matter where you have your money. So the market has made it through some serious rough patches thus far, and we've always recovered. And so while there's no guarantee of future returns, we have every reason to believe that it will make it through future challenges down the road. And over time, the market has always gone up. It's like yo-yoing while walking up the stairs. The market is going to go up and down like the yo-yo, but the average return across the course of time, if you're investing for 30 or 40 years, you're going to make money. Your investments are going to be worth more than they were when you started. So ups and downs in the market and even big downturns or corrections are normal and to be expected. The media loves to sensationalize it and make it seem like investing is just this terribly scary thing that you have to be so cautious with. But a long-term investor in those times, we just drink our coffee and move on. Or we buy more because we're like, hey, everything's on sale right now. It's a downturn. Sweet. It's going to be worth more in 10 years or 20 years. So that idea that investing has to be risky, it certainly can be. You can definitely make it risky. It definitely doesn't have to be, though. And there are so many simple, boring ways to use it to build wealth for yourself that we just all have to know that it's an option.
Yeah, it's so important. And I just want to piggyback on that and just say it can still be difficult to see your investments lose a lot of value. I mean, like I talked about earlier, seeing $600 extra come passively felt awesome. And seeing that $600 decrease in my account that might happen if the market has a downturn will feel pretty bad, right? But you have to learn to separate your emotion from it and look at it objectively and big picture and realize that you need to keep that money in there so that it can continue growing and not just panic and take it out when your funds are worth the least that they've been worth up until this point, because that's actually the worst time to be taking the money out. So people will end up losing money when they're constantly buying and selling in the market. But when you buy and hold index funds over time, the chances of losing that money is almost non-existent. So in other words, the more boring and simple and consistent your investing strategy is, the better.
Yeah, it's called, timing the market. Like, I know when it's going to go up or I know when it's going to go down and I should sell now or I should buy now. Like, forget all of that. That is a total time suck and an energy suck.
Yeah.
And we're teachers and we don't have all the extra time and energy for that. But it's also irrelevant because we're buying and holding over the long term. And we don't need to worry if the market is up a little bit or down a little bit because we're walking up those stairs. And when we get to the top, it's going to be awesome. So, myth number 3, investing is only for people with careers in finance or banking or insurance.
Ugh.
That was awesome.
I just hate that myth. Not people in finance, banking, or insurance, for the record.
I'm glad you clarified. So that is definitely not true. Oh my gosh. Now more than ever, investing is easy and accessible for everyone to learn about. There has been this growing movement of DIY or self-directed investors building for years. And there are so many more resources and options available now. It's ridiculous. Like you can pick any platform or media source and find all the advice and information that you need to feel secure in making your own decisions. That's what I did 17 years ago now. My sister and I just read a couple of books, which literally that's kind of all there was back then. And since then, I've continued learning and listening and growing and like talking to people that I know that are in the finance and banking and insurance world and have just continued to build that reserve of knowledge and confidence. And I have a track record now going for us that is proven. And it's so exciting to know that like I did this on my own. Like literally no one in my family invested and talked about it. Mm-hmm. Nobody that I knew was a mentor for me. And it's so exciting to think that like it was easy for me. And now it's even easier for all the people who are looking into finding out about it today. So definitely count that out, that you have to be a finance-minded or professional to at least know what's going on with your money and your investing, if not manage it all on your own. You have to have that information and knowledge no matter what. And it's available to everybody and it's super accessible now.
Yeah, the barrier to entry is like super low. And in some cases, totally non-existent at this point, which I think is a beautiful, beautiful thing. And so all it takes is a few simple steps and understanding the basics. So just a bit of knowledge that you understand the basics, you understand which funds you're investing in, and then everybody can build wealth through investing. And teachers are included in this. That's why we have specific investing vehicles for us, like 403Bs and 457s, and of course IRAs, which aren't teacher specific, but they're also available to us.
Yeah, I mean, I have a Roth IRA for David, a Roth IRA for me, my 457. David has an individual 401k, and I have an HSA. And I manage all of those and set up all of those accounts on my own over time. I mean, I didn't do it all in one day. And over the course of 17 years, I've made some adjustments and some small changes as I've learned more. But my main strategy and philosophy has remained the same. And it's so exciting to see what's grown for us over the past 17 years and how that's projected out into the future now.
Mm. And that takes us to myth number 4, which is that investing isn't important for younger people. I hate this. I hate it all. So I understand this, though. While I hate it, I do understand it. Because we're thinking, okay, well, that's not for me because retirement is so many years away. Why do I have to start thinking about retirement? You know, I mean, if retirement is even what you're investing for, but there are other things that you can invest for as well. I also understand, especially as teachers, having the instinct to put it off. I know pretty much, I think, like at least 3 of my friends who are first year teaching, I would kind of mention some things to them and they would just say, I'm just going to wait until summer and then figure all of that out, which honestly I get, right? It feels like a huge task and we're already stretched so thin during the school year and constantly if you work over the summer as well. But I just want to make sure that everybody is sticking to that plan to make it happen. If you say you're going to do it over the summer, do it over the summer, if not earlier. And remember that investing even 1 year earlier than you might be planning to can change your wealth exponentially. That might add 3 more years to your retirement, right? So please, 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 please. That was a totally random number, by the way. That was not anything I did math to find out. But it really can change your life that much. So taking the steps as early as possible is super important.
Yeah. And that's where we can get into a couple of examples here. So let's say we have two investors. The first is Jessica, and Jessica invests $2,500 a year from the ages of 25 through 65, which means in total, Jessica is putting $100,000 into the stock market. Jim invests $5,000 a year, but he starts at age 45 and goes till 65. So Jim is also investing $100,000 into the market. Jessica's just starting 20 years earlier than Jim. So you'd think like, they'll probably end up with about the same amount, right? Like they both put in 100,000. They're both going to be done at 65. They should be pretty even. No. Jessica ends up with $586,000. Jim ends up with $286,000, less than half. And that's with a conservative rate of return of 6 or 7%. So the point is that time in the market is crucial. And timing the market is bad, going in and out and trying to decide when it's up and down, but time in the market is crucial. And so that said, it's never too late to start. It's always better to start, as soon as you can. But just thinking I'm young and I've got all this time, but you can use that time to work for you. And don't let it pass you by if you can, because you can leverage so much of that compound growth by starting early. And that's a term you'll hear a lot in investing and personal finance dialogue is compound interest. The power of compounding interest. And people will say, Einstein said it was the eighth wonder of the world. And the stock market does not pay interest in the way that a bank pays interest. A bank pays compound interest on a savings account or a CD based on a fixed rate. But the market has what people often call compound interest. It's compound growth. It's growth upon growth. So as the companies in an index fund grow and become more valuable each year, so do your shares of those companies. And the more time they have to grow, the more money you'll end up with in the end. For example, in 1 year, the value of your shares might grow by 7%. Then the next year, they might get 10% on top of that growth. Then the next year, 6% on top of that 7% and 10%. So that's that compounding that happens that is undeniably an incredible way to build wealth passively. And if you have those down years in there, maybe I lose 3% this year, then it's made up by adding 6% the next year. And that's one of the most magical and yet true facts of the stock market is that compound growth benefits with the more time that it has to work. And it happens passively.
Yep. So just like the example I gave earlier of earning $600 in my investment accounts last month, some of that was based on the contributions I already had in there. And some of that was growing on top of the interest that my investments had already gained. So it's just a beautiful thing to actually watch it happening in practice.
And I do want to jump in and say there is one way in which it is growth, and that is if you have dividends and you're reinvesting those dividends, then you're buying more shares of the stock with the money that you're getting from the dividends those companies are paying. So in that sense, it is, you're adding more money to it. But then otherwise, it's just the value of those investments growing over time.
Yeah. So in closing, we just want to say that we know how overwhelming investing can feel before you start to really get into it, especially as it's normally presented to us in those rare retirement workshops that we have as teachers, and especially also in the media when we've got this sensationalized version and they're talking about individual stocks. But our hope today is that by tackling these myths in the podcast, you can check off one step of your investing to-do list before we dive even deeper into the details in the next few episodes.
Yeah, and that's what we wanted to start with was small pieces so that we take that big overwhelming picture and break it down into something that's manageable. And you can go, okay, those 4 things that I was thinking about that were kind of off-putting about it all maybe aren't so scary now, and you can understand how they really work in real life versus sort of the sensationalized or overgeneralized perspective we often see out in the world. One recommendation, we're going to try and suggest another resource to go to in each of these episodes. And while I've read lots of books on investing and personal finance, the one that I would love to recommend to people today is called The Simple Path to Wealth. It's written by a man named Jim Collins, or J.L. Collins. He has a blog. And I loved this book. I actually listened to it on audio. And first of all, he has the most comforting, soothing voice. And he's he's so like nonchalant and like this. It's just like you're sitting on the front porch with him drinking tea. And he actually wrote the book for his daughter, who did not want to hear any more of his investing mumbo jumbo. She was like, Dad, I get it. I know it's important, but I just don't care as much about it. And he was like, oh, I need to write this in a way that people who don't care about it can still learn a ton and do exactly what they need to build wealth. And that is exactly what he did in this book. It's so powerful and just presents all this information in a way that is so digestible and fun to listen to. So if you're going on a summer road trip, or you're doing a trail run, or you're just doing chores, put on The Simple Path to Wealth. And Jim really has a lot to offer in that book.
I love that. So make sure you guys tune in to our show next time to hear about all of the investment account options that we have as teachers, how they're similar, how they're different from each other, and start to consider which one might be best in your specific situation.
Yeah, so we've talked a little bit about the accounts and what you put in them in this episode. And next time we're going to just say, okay, what are the accounts? How do I open them? What are they? What are the advantages and disadvantages? Because that's really the starting point. Once you kind of agreed to jump into investing, it's which account do I need to open first?
Yeah. Well, I'm so glad we got to start talking about one of our favorite topics together today, Christy. Once again, if you guys have any questions about this, because this can be kind of a hairy topic, or if you just want to share something about your investing journey, send us an email at teacherstalkmoney@gmail.com. And have a fantastic rest of your week. Bye, everyone.
Yeah, we can't wait to be back in your earbuds. Thanks for listening, everybody. Thanks so much for joining us here on Teachers Talk Money.
Subscribe now to make sure you don't miss a future episode.
Leave us a review of this podcast. It helps more teachers find us.
Share it with a teacher friend who can use some of this information.
You can find more money advice from Christy at Financially Fit Teacher on Instagram and Rachel at Teachers Talk Money on Instagram and YouTube.
All opinions are our own, and our awesome theme music is by John Bartman.